our latest economic forum. I'm Shimit Chowdhury, and I'll be chairing today's forum. If you could just go forward to the next slide, please. As part of the welcome, just kind of wanted to take you through what we'll be running through today. Now, in recent weeks, kind of the focus has clearly been on what's taking place in the Middle East and the potential impacts from higher oil and gas prices. And it's safe to say there's kind of lots of uncertainties around that, and it's too early to tell how the UK economy might be impacted by that, whether that be from an inflationary impact or whether that be from a GDP one or one around the public finances. So while it might be too early to talk you through what some of those impacts might be, we can talk you through what we know so far and kind of look back to where the economy is today relative to 2022, just to gauge some of the potential impacts that might take place. And our Chief Economist, Grant Fitzner, will take you through the latest state of the UK economy as of kind of early 2026. We're then going to take you through some of the kind of core updates that we feel will be of interest to the kind of wider user community. And all of these are kind of relevant to not only our core outputs, but also understanding some of these impacts that are taking place through the economy. So first, you're going to hear one on kind of how we go about producing our estimates of population, but also population projections, and the ones that will be coming out this year. We'll then have an update on the recent communicated changes on the CPI inflation basket and what's come in and what's come out of that in terms of our understanding of how we measure CPI inflation. And then the final update we'll give is on some new communications that we've done to really communicate the focus on kind of new real-time indicators, which have become very popular in recent years, and I imagine will continue to do so over the course of this year. So there'll be plenty of time for Q&A. So please post those via Slido, and we'll get through as many as we can. Now, if we could just go to the next slide, there's just one final bit of housekeeping I wanted to do. So in terms of the Q&A, we'll be running that via Slido, and the code here is 25574. And as I say, we'll get through as many as we can. And those we don't get to today, we'll respond by email, hopefully by the end of this week. Also, just want to encourage user participation. So the hashtag that we have for this one is ONS Econ Forum. For those of you who just want to just kind of post some of the material that you might be of interest today. So if we go to the next slide, I believe I'm handing over to Grant at this stage. Just to let you know, we are recording today's forum. We know that this is one that's been kind of interest by previous users, so I will be uploading this, and hopefully that will be up there in the not too distant future. So I think at this stage I'm handing over to Grant. So look, big welcome to everyone here, and I look forward to your questions. Thank you very much.
Thanks, Shimit, and good morning, everyone. So a lot going on in the UK economy. Some of the data, of course, in fact, most of the data still reflects the situation before the outbreak of the Iran war. So just do bear that in mind as we go through the results. This time around, we're going to have quite a big focus on energy rather than just the usual kind of regular monthly economic statistics, but we'll try and cover that off a bit as well. And of course, lots of time for questions at the end, so look forward to those. So let's go on to the next slide, please, Liz. So first, a little bit about the growth. So the grey bars represent the actual quarterly, that's 3 month on 3 month GDP growth in the UK economy. And as you can see, that's come down significantly over the past couple of months. And in the latest quarter, we saw some really quite low results in terms of quarterly GDP growth. And then the little dots represent the Office of Budget Responsibility forecast. So the green ones were back in November of last year, and the blue ones, their most recent economic forecast published alongside the Chancellor's statement a few weeks ago. It's fair to say that the OBR were expecting growth to be reasonably solid in the order of around 0.4 a quarter. I think we'd all have to expect that growth will be lower, at least in the short run, because of the impact of the energy shocks on UK households and business, which we'll be talking about in a bit more detail. And if you look at the OBR's estimate of the output gap, which is the difference, effectively how much spare capacity there is in the economy, the most recent estimate of that, the blue line is larger than what they were looking at in November, so suggesting more weakness in the outlook for the next couple of years. Now, with the important caveat that all of these forecasts by the OBR were essentially done in a pre-Iran war period, and no doubt will be revised in the autumn, significantly revised in the autumn statement later this year. But it's fair to say the general expectation is that growth will be weaker, not just in the UK, but globally because of these shocks. Of course, there's still a high level of uncertainty about how long the war will last and what the medium to longer term impact will be on energy prices and supply chains. Let's move on to the next slide where we kind of start to unpack that a bit. So the most immediate effects, obviously, higher petrol and diesel prices, although important to say not yet back at the kind of levels you saw in 2022 and early 2023, but certainly moving higher. A significant element of 2022 was actually more around supply shocks, which had then impacted price. We're getting a combination this time of both reductions in supply, particularly oil and gas coming through the Strait of Hormuz or from Qatar, and the market reacting to that by pricing in higher oil and gas prices. Interestingly, one of the things that's occurred this time, which wasn't the case in 2022, is that Brent oil, kind of European oil prices are significantly higher than the West Texas US measure, reflecting the fact that the US is now the largest oil and gas producer in the world and has security of supply in a way that Europe doesn't. In terms of how this will impact on households, petrol and diesel fairly immediately, obviously, but in terms of electricity and gas bills, we have a system with Ofgem of quarterly caps and quarterly reference periods. And so we're currently in the reference period for the third quarter of this year, which kicks off on the 1st of July. So if we do see a significant increase in that cap, it won't kick in for a couple of months. Obviously, the government are looking into ways that they can support people. There hasn't been an announcement yet of what kind of energy policy there might be, or indeed whether we see a repeat of the energy price guarantee of 2023. And I think that partly depends, of course, not just on what government policymakers decide, but also how long the current crisis continues and how quickly energy prices return to kind of more normal levels. Next slide, please. So the National Institute have done some modelling of what would happen if oil prices rose to $100 a barrel. They're actually above that at the moment. If you look at the chart on the left, you can see that over one quarter, a small negative impact on GDP, quite a significant impact on headline inflation, and also higher interest rates. Now, it's important to say these are econometric models. They rely on a whole host of assumptions, and they're modeling, obviously, an uncertain future. So these are not precise forecasts. They're kind of indicative of the likely impacts. And a key factor here is to how long those higher prices would be sustained. And of course, that very much depends on what happens in the Middle East over the next couple of weeks and months. But nonetheless, I don't think anyone would be surprised to see that their modelling suggests a significant fall in annual GDP growth and a significant uptick in the UK inflation rate. Now, we are publishing our inflation numbers for February on Wednesday morning at 7 o'clock. Just an important caveat, because the war broke out on the 28th of February over effectively a weekend, it's not reflected, it won't be reflected in the consumer price numbers that we publish this month. You might expect to see some of that coming through in next month's bulletin, though. Next slide, please. So here's where we are on the labour market. I mean, the story for the labour market for some time has been, in fact, for several years, has been declining job vacancies and a rising unemployment rate after the very strong labour market we saw post-pandemic in 2021, 2022. No real changes in that trend yet, although I think it's interesting to note that the vacancies rate appears to have effectively bottomed out. In other words, it's essentially stopped falling. It hasn't picked up. And the unemployment rate has continued to rise over the last couple of months. where that will plateau remains to be seen. But obviously, if the growth outlook is weaker now in the coming year, then we may see some further deterioration in the labour market in coming months. In terms of something that's a little bit more optimistic, at least from a central bank perspective, I guess, would be the fact that private sector pay growth has been going steadily lower, and that reduces pressure, inflationary pressure, particularly in the services sector, which is one of the things that the Monetary Policy Committee watch. But it also means that real wages, which have actually been improving over the last couple of years, that does put some pressure on real wages, both in terms of falling pay growth and potentially rising inflation. So I think real wages will be something to watch, and if they turn negative again, obviously that would have a negative impact on household savings and consumer sentiment. Next slide, please. Here's the headline inflation numbers. Last month they fell from 3.4% to 3% for the Consumer Prices Index. Core measures have also been coming down, albeit more gradually. And then turning to the business side, this is from our fortnightly Business Insights and Conditions survey. Labour costs continue to be the largest single factor behind price rises, followed by energy prices and raw material prices. That really hasn't changed in recent months. It's fair to say, though, that one other factor that we measure in the BIC survey is what's driving turnover expectations. And economic uncertainty has been a major factor cited by many businesses, not just in recent months, but actually for several years. And I think it reflects the fact that post-pandemic, it's just been a more volatile world. We've had supply chain shocks, recession, war, energy shocks, all sorts of, if you like, one-off events, one after the other, have created, I think, quite a difficult environment for businesses to make medium to longer term investment decisions. And obviously the current war just adds to the mix there. Next slide, please. Now, taking a more granular look in terms of which industries will be greatest impacted. These are the more energy intensive industries at the top. Industrial gases, inorganics, fertilizers, chemicals, rubber and plastic goods. I don't think anyone would be surprised by that, but also worth noting air transport. So clearly airlines are already facing higher avgas prices, and as well as for those doing long haul, the disruption of lots of airports being closed in the Middle East. So both that disruption to travel plans and the high fuel costs, I think, will already having a significant impact on that sector. And so I think although it's more around manufacturing, there are certainly some service areas that will be quite badly affected by higher energy prices as well. And of course, transport and logistics, you would probably add to that mix too. We do publish quarterly estimates of energy intensity alongside our headline inflation numbers. So for anyone who wants a bit more detail, do go have a look at those. Next slide, please. So turning to households, I talked earlier about consumer confidence. And if you look at the blue line, personal financial situation, obviously it fell quite dramatically post-pandemic, particularly during the recession, the economic downturn, and the period of high inflation. People's assessment of their own personal financial situation has improved back more or less in line with the long-term average since then. And also quite a lot of people are saying now is a good time to save. But they tend to be more pessimistic around the general economic situation and have been for some time. Again, this is something that we'll be looking at in coming months. I would not be surprised if consumer sentiment does fall in response to those higher headline inflation, higher petrol and diesel prices, etc. But I think one thing that is potentially encouraging is because we've had several years in which real wages have been rising and inflation's been coming down, households have been able to actually save a significant amount of money. So the household savings ratio peaked above 10% recently, is still quite high by historical standards. And if you look at if you go back to around 2010, it's pretty much on a par with where we were post the global financial crisis. Now, what that means is not all households, but many households potentially have been able to pay down their debts, put some money aside for a rainy day, and are probably in a reasonable financial position to be able to weather at least a short-term shock in terms of higher prices and cost of living. So we're not in the situation that we were, say, back in 2021 or 2022 when headline inflation picked up dramatically. So that's, I guess, a positive. I think the fact that we may see real wages, the growth in real wages start to dissipate over the next 6 to 12 months is the potential negative. But let's wait and see. Next slide, please. Okay, so finally turning to public sector borrowing, we published our latest monthly public sector finance numbers last Friday. They do show that borrowing has come down somewhat below the Office Budget Responsibility forecast, but interest rates are significantly higher post-pandemic than they were before the pandemic. The navy line is UK gilts, the green line is UK treasuries, and the purple one is German bunds. Interest rates have stayed high for several years now, and I think it's fair to conclude that the period after the global financial crisis of quite low official government rates, bond rates, seems to have ended. We're in a period of higher interest rates. That reflects a number of factors. But clearly, the prospect of higher inflation is unlikely to see government rates fall dramatically anytime soon. It also means it also has a significant impact on the government balance sheets. Around a quarter of UK gilts are linked to the retail prices index. And obviously, every time inflation picks up, the RPI picks up and adds to the cost, the interest debt payments that those gilts pay. But more generally, an environment of higher interest rates means that the UK government, like many other governments around the world, spend a significant amount of their taxes on paying off debt, and certainly, or rather, servicing their bonds. There's no sign that that might change anytime soon, but it is one of the kind of fiscal pressures on government spending, and again, no prospect that interest rates will necessarily fall anytime soon, but something to watch. And I suppose the other thing that's interesting in this chart is the extent to which US Treasuries and UK gilts have followed each other quite closely over the post-pandemic period. And just to sum up now, if we go to the next slide, please. So obviously, the UK economy will feel the impact of the recent energy shocks. There's a high level of uncertainty about how long those higher prices will persist and their impact on inflation. Clearly, some prices are already flowing through, price of petrol and diesel. I think something to think about here is that it's not just the immediate impact of higher energy prices, it's really the sort of second wave of impacts on manufacturing costs, on travel. I mentioned as those higher energy prices work their way through the economy and kind of ultimately it lead to kind of broad-based inflationary pressures, and those can persist beyond the initial energy shock, as we saw post 2022, particularly if they start to factor into higher wage claims, which then feeds through into services inflation. So there are both the immediate impacts and then the medium to longer term effects of energy shocks. Output and employment growth have slowed in recent months. There is some significant labour market slack that's putting downward pressure on wages, which I guess is helpful for core inflation. And we've also seen both the headline and core inflation ease in recent months, but businesses still continue to report significant cost pressures. The exposure to energy prices varies significantly across different industries. Obviously, chemicals, fertilizers, etc., being impacted. One of the other kind of secondary costs to watch potentially is food prices. A lot of agriculture in the world relies heavily on fertilizers to boost productivity, boost yields. Because of the significant increase in fertilizer prices, we may see crop yields coming down, and that is likely to drive up over a longer term period, 6 to 12 months, costs of grain and other agricultural products. So even if the current situation abates soon, you'll still see some longer term ripples from those energy shocks coming through in things like food prices. That's it from me. Look forward to your questions. Thanks, everyone.
Excellent, Grant. Thank you very much. And hello, everyone. My name is Chris Stickney. I'm a senior statistician here in the Population Statistics Directorate at ONS. I'm going to talk to you only for a few minutes about some updates on our population estimates and when to expect them and some of the changes coming up as well. So if you go to the next slide, please. Colleagues or those on the call may know we were recently working on an admin-based population estimate method, or ABPEs, and we published a lot of reports and evidence behind that method, but we've made a change to our approach recently and are moving to what we call a continuous improvement approach. And it's quite useful to hear Grant talk about a number of economic measures, and many of them rely on a per capita rate. And so our aim is to continue to publish our mid-year estimates under the current methodology, which is a cohort component-based method. So we take the last year's population estimates or the census as a base, and we add on births, deaths, and take into account international migration and internal migration. We will continue to make improvements to those, but we want to do it in a way that's incremental rather than a big switch to a new method. And that way you don't have a big step change in our method, which again is probably quite useful for any time series analysis that's done. When we make improvements, though, we are going to use a research maturity framework, so that way we follow our improvements through stages rather than make a big ambition to switch in the future. And there's a lot of work we will do, though, particularly to migration, to get the population estimates right at local levels. That's both international migration and internal migration. Our current mid-year estimates, as I said, we were developing ABPEs. So our current methods, we are working on improving those so that they can be iteratively built. So improvements to how they're produced on the right platforms and the right people, etc. But I also want to talk to you about what to expect and when, as I know that's also quite a key user need. So if you go to the next slide, there's 3 swim lanes you can see here, and a lot of our population estimates hinge on the timing of international migration releases. So that top swim lane gives you a sense of when we're publishing migration statistics and why they're so crucial to our population estimates. That middle swim lane is when we are publishing population estimates. And on that left-hand side, you can see we started producing every November a UK mid-year estimate, not by age or sex or by geography, but just a high-level number that gives you a very timely population estimate for per capita needs. So we started doing that in November, and you can expect that now, at least for the foreseeable future, every November. And it's timely because as soon as our migration estimates are published, we can then do that for a UK population estimate. This summer, we'll publish our usual mid-year estimates. Again, it'll be that same method that we've been doing year after year using the cohort component method. They will be revised back to mid-2022. And again, that's because of our migration estimates, which, because they're admin-based, they will be revised quite considerably or quite regularly. So users can expect our mid-year estimates to be revised to take into account migration. And then on the right-hand side of that middle swim lane, you can see we'll follow that cycle again. We'll do a November release for a UK estimate, and then our summer mid-year estimates next year, and so forth. Now, what does that mean for projections? In December, we published subnational population projections. Those were 2022 based. We'll publish a 2024 based national population projection next month. And then you can see that kind of gap in between as when we're going to look to re-platform our projections and get back into a sort of cycle of every 2 years doing national and subnational population projections. So in early 2028, you can see we'll publish 2026 based national and then subnational projections. Now there's a lead in time. We know projections are used for a number of things, including survey weights. So if you go to the next slide, there's sort of expectation in terms of when subnational projections will feed into our labour force survey weights. We published back in December our 2022 based subnational projections, users can expect to see the labour force survey reweighted with those around November 2026. So a lot of dates there to keep in mind, but hopefully giving you a sense of what to expect and when. Thanks. Okay, we'll pass to the next presenter.
Good morning, everyone. I'm Stephen Burgess. I'm the Deputy Director for Prices Production, with a couple of slides here about the update to the consumer inflation basket. We put these two articles out. Nathan's going to show a link, I think. We put these two articles out at 9:30 last week, so almost exactly a week ago, and there was good coverage across all the major news outlets. Next slide, please. So these are the most attention-grabbing stories that we put out last week. So the first one is that we've added a few new goods to the inflation basket, including hummus, alcohol-free beer, dashboard cameras, and adult dog grooming. Those are all new to the basket this year. And we also take out items where spending appears to be dwindling. And one example of that this year is on sheet wrapping paper, where when we talk to price collectors, it's increasingly hard to get quotes for sheet wrapping paper because so many of us now buy it in rolls anyway. Another example was purchases of premium lager in restaurants, where we think spending is declining as well. I always think the basket headlines are quite an interesting read on social trends as well. I can remember when I first started going out to first started drinking in the early 2000s. Like if I'd been drinking alcohol-free beer, I'd have been laughed out the room, I think. Whereas now it's much more widely consumed, and you can see that the selections of it available are much wider, and there's more shelf space being allocated to it in shops as well. Next slide, please. So those are the main headlines, and this slide covers more of the kind of underlying economics of why we make these changes. So we make these changes to the consumer prices basket every single year to take account of changing consumer tastes and preferences. And this year we added 27 and removed 19 items. So relatively small changes compared with the overall size of the basket, and leaving it at 760. And the idea of this is we have a fixed basket that we fix for a single calendar year, and then we update the contents every February to make sure that our monthly inflation statistics remain relevant and high quality as the economy changes. And we also update the item weights and the base prices for CPI and CPIH at the same time. And we put a similar article out about those this time last week. There weren't huge changes in the weights this year, reflecting the fact that expenditure hasn't shifted recently in quite the same way it did, for example, during COVID. There was a slight increase in the weight on housing at the expense of most other divisions, reflecting the growing importance of housing costs. There's one other thing I wanted to flag that's really important happening in the next inflation release, and that's that we're introducing a landmark change to introduce grocery scanner data for 50% of the market. This has been widely telegraphed, and I think people presented at this forum before about this, but I wanted to flag it's this Wednesday's release when that will go live for the first time. And I think what this means is you can see a consistent story between this and the basket changes, which is that we're continuing to improve quality, granularity, and coverage as we go along, and that will ensure that we continue to produce the high quality inflation statistics I know many of you rely on. That's all I wanted to say. I look forward to your questions later on. Thank you.
Thanks, Stephen. So, hi everyone. I'm Peter. I'm from the digital publishing team at the ONS, where I'm a data visualization specialist. And I'm just here to give a quick overview of our new RTI dashboard, what it is and why we created it. So to start, kind of what are the real-time indicators? We go to the next slide. So they bring together a range of indicators that give an overview of the UK economy and society based on new administrative data sources, rapid response surveys, and innovative methods. And they cover a range of areas. And together they act as a barometer for economic change, sitting ahead of official statistics like GDP. So the new dashboard we've developed replaces a weekly bulletin that was labour intensive to produce and not particularly good at communicating the trends week to week. So the dashboard provides a clear way of presenting the data. It's largely automated, which frees up our analysts' time, and it's part of a broader ONS push towards kind of making this kind of economic data more visual and accessible. So I'll jump to show the new dashboard now. Hopefully you can all see that. So it's very simple. We have indicators grouped under 4 headings. There's a fixed ordering week to week, but you can see from these flags which indicators have been updated in that week's release. And you can see the date at the top that it was last updated. So new data goes into the dashboard every Thursday. And in terms of the data that we present, you can see high-level information for each indicator. Then you can click through to get the trend for the past 2 years, and then the key changes over the most recent period. And you can also click through there to get to the full data set with the full metadata for each of these indicators. So yeah, a real world example where you might kind of use the dashboard could be the Iran conflict. So there's a number of indicators here that might show kind of early changes in relation to that kind of event. So in the first full week, you saw gas and electricity prices move with a smaller percentage change in flights. You could also look at the volume that people are topping up at petrol stations or shipping data. And that illustrates how the dashboard can let you track events that may be feeding through to different parts of the economy. So there were lots of things we had to take into account in the design of the dashboard. The indicators all vary in terms of frequency. Some are daily, some are weekly, some are monthly. And there's different lags for when we get the data. Some are indices, others aren't. We try to balance consistency and comparability while accurately the kind of specific information about each data set. So just one example kind of where we've done that is all the charts have consistent x-axes, but some of the charts stop a little sooner where the series are less frequently updated and end earlier. So the aim is to make everything as clear and as transparent as possible. So yeah, in conclusion, and to look at next steps. So the aim of this is to give a fast indicator view of the economy. We have monthly analytical articles that remain in place to provide that kind of deeper interpretation and insight. In terms of future development, new sources will be added over time. We recently added Revolut spending data, and there's other indicators that are planned to be added soon. Some indicators may be removed as data availability changes. And finally, I just want to say this is a new format for presenting data that we've worked on. We've had strong early feedback on usability, but keen to hear from this audience too. So yeah, on the dashboard, there's contact details for the RTI team. So yeah, we'd love to hear kind of feedback on the dashboard from you. That's all from me. I think we're now onto the Q&A. Thanks.
Thanks very much, Peter. And to all our speakers today, as I said, we try to provide a few updates on material that might be of wider interest to those who come along to the Economic Forum. And I think in particular, some of these are particularly relevant to some of the themes that Grant spoke about in his reflections on the state of the economy. So there's a few questions that have come in to the Q&A. I'm going to get through as many of those as I can in the next 15 minutes or so. So I think the first one is for Grant. Why does the energy price shock affect UK GDP more than world GDP? Is this related to the UK being an energy importer? So Grant's kind of just offer maybe a few reflections on how the UK, the terms of trade shock that the UK is facing, but maybe something also about energy pricing in the UK.
Well, if you're talking about the National Institute's modelling, one would need to look at the various assumptions. Look, I think different countries will be affected differently, reflecting a number of factors. One, obviously, are they an energy exporter or importer? But second, also the kind of mix of industries and services in the economies. As I think one of those slides showed, some industries are much more energy exposed or energy intensive, if you like, than others. We actually have a relatively small chemicals industry in the UK now. A lot of chemical production has moved to kind of lower energy countries, and we're very much more a services economy. So that will affect specific aspects like travel, for example. But typically services are more labor intensive and less energy intensive than manufacturing and production. So in some ways we're less exposed in terms of the industry mix. I think the big difference between now and the big energy shocks, not so much of the 1970s but 1980s, is back in the 80s and 90s, UK was a net energy exporter. In fact, I think at one point we were the 5th largest oil producer in the world. We no longer are. We're now a significant importer of oil and gas, and that has grown over time. So that does make us less secure, if you like, and more vulnerable to energy shocks of this nature. And then there are some more specific points around kind of what kind of refineries we have and whether they're refining the oil that we produce locally or imported oil. And also that we don't have much in the way of gas storage compared with, say, a lot of European countries. So the fact that we're an importer, the fact that we don't store a lot of gas does make us more vulnerable to those immediate price shocks than other countries. And I think what's really notable is less how the UK is different from 20, 30, 40 years ago, but actually how the UK is much more in a much different position. The UK is now the US is now the largest exporter of oil and gas. So they're in the quite happy position that not only have they secured domestic supply, but they can actually make lots of money by selling their surplus oil and gas to the rest of the world, including Europe with LNG, for example. And that's, of course, largely because of the fracking revolution that we've seen in the US. So I think the US is in quite a strong position. The UK and most of Europe is in quite a weak position relatively, but it's not just the UK. A lot of Asian countries are very exposed, Japan, for example, to oil imports. So I think it's a mixed picture across the world. One other point to note, though, a lot of people are making comparisons with the oil shocks of the 70s. A key difference is that the UK and other advanced economies are much less dependent on oil than they used to be, partly because of greater energy efficiency, but partly because we've actually reduced our consumption over that period from where we were back then. So I'm not trying to diminish in any way the potential impacts on growth. But firstly, even at current prices, oil in real terms, adjusting for inflation, are lower than the price shocks of the 70s. And secondly, we're much less dependent on oil in terms of energy intensity and efficiency than we were back then.
Thanks very much, Grant, for that one. If our response, which hopefully was kind of helpful in terms of just understanding some of the mechanisms in place for how higher energy prices might impact upon the UK. So there's a couple that are coming from. I'm going to put together. These might be for Peter, looking at these ones, which is clearly just an interest in real-time indicators at the subnational level. So is it possible to obtain job market and vacancy data for specific local areas such as LSOAs, wards, or local authorities? I think LSOAs is local super output areas, but essentially at a subnational level. And then a similar one, are any of the real-time indicators available locally, and particularly with ITL2, which is just a level of regional classification. But Peter, any information you can provide on that one?
Yeah, thanks for that question. So some of the indicators are available at regional level. So I think those are retail footfall, new job adverts, and EPCs. But I think they're just available at ITL1 at the moment. The team would like to go lower, but haven't achieved that yet. And yeah, we don't have those regional breakdowns on the dashboard at the moment, but those are available in the data. But yeah, if that was something users really wanted from the dashboard, then we could look at kind of how we could incorporate that.
Thanks very much for that. And I think an important bit to say also with real-time indicators is that it's quite an evolving one. If you look at what we first published, I think in the late 2010s to where we are now, there's been quite a lot of progress, and as more information becomes available, so we might be exploiting new real-time information. So not to necessarily forecast where we might be on those ones, but I suspect that might be one we can come back to in the coming years or so. So there is one, I think, for Grant, where you touched upon, are there any plans to further analyse the effects of fertiliser supply, the extent of inflation and lag of particular interest? So I think this was in your, we focused primarily on energy prices, but I think one bit you spoke about was potential food price inflation because of fertiliser. So I didn't know if there's anything you want to add further to your reflection.
Well, I mean, this is going to affect global agriculture, not just the UK. And like I said before, it very much depends how long the current crisis lasts and how long elevated energy prices remain. And this is more a point for sort of global agriculture than the UK specifically, although obviously farmers here are facing the same challenges as any others. In a number of countries, farmers are now having to make a decision about are due to kind of plant some crops for the summer and are having to kind of think about, or autumn, whether they fork out the extra money to buy fertilizer or not, or indeed whether they grow wheat or soybeans. So my understanding, based on some recent reports, so not an official position here, is that UK farmers may be switching from wheat to soybeans because that doesn't require the same level of fertilizer input. That could potentially impact on wheat prices down the road. But a lot of this is speculative. People will be watching the Food and Agricultural Organization kind of monthly food index quite closely in coming months. And a lot of these things will occur with lags. But I think it'd be very unusual if, given the big increase in fertilizer prices, we didn't see that start to impact on some agricultural prices, particularly grains, later in the year. I think that's the general expectation. And obviously that will affect the UK, not just in terms of domestic production, but the price of imports. That does follow a period where we've seen food price inflation actually come down quite markedly over the last couple of years.
Thanks for that, Grant. And I think that actually covers another one that came in as you were speaking. So no need to come back to it because I think you've covered it. But is it fair to say that both the rising cost of fertiliser and the transport cost of importing food to the UK will contribute to significant food inflation? So while we can't necessarily forecast what will take place, I think those are the kind of ones that we will be looking for in the coming months in terms of that inflationary pipeline.
And maybe on that, we should probably just briefly mention producer prices do separate out domestic versus international imports of food. And during the 2022-23 period of high inflation, we saw particularly imported food prices pick up quite markedly. So I think that's one of the kind of regular monthly economic indicators will be quite closely watched in coming months.
And I can see Stephen nodding to that one there as well to confirm that. One which I'll come to Peter for is, how is the real-time indicators dashboard made, specifically the technology? So I think a little bit of a technical one there, but clearly there was interest in that. Any high-level reflections you can offer on that one, Peter?
Yeah, thanks for that. So it's something we coded up ourselves in Svelte, which is an open source kind of component for making web products like this. The charts use something called D3, which is the kind of standard JavaScript library used for visualizing charts on websites. And it's kind of powered by a couple of CSVs that have the data in that are just updated week to week. We'd like to power it by an API in future, so we can kind of completely automate the updates week to week. And that's kind of something we're looking at as part of a wider push to use APIs across our website.
Thanks very much for that. Just couple more that I'll look to get through. I might come to Chris for one, which is on kind of international migration figures. Can I obtain UK international migration data for specific local areas, such as a city? So I guess this comes back to this kind of interest in subnational economy and anything we might have at that level.
Yeah, we do publish international migration at local authority level, both those coming in to the UK and those emigrating as well. I'll publish a link maybe in the chat, Sumit, if that's helpful. They are point estimates. However, they're very complex in terms of how they're produced. We use a lot of admin data sources, tax and benefit data, particularly for those over 18, and health data for those under 18. And some other sources as well. So it's complicated. I'll publish where you can get that level of information, but also it might be worth looking at the methods just to understand a bit about the sort of uncertainty and how they're developed. So yeah, I'll publish that, Sumit. Put a link in the chat, Sumit.
Thank you very much. There's obviously a lot of interest in kind of migration flows in and out of UK, but also understanding your local geography. So yeah, it'll be fantastic to see that one. Just a couple more. I'm not sure we can comment too much on this one, but I'll still raise it. So what impacts would it be on the UK public finances with government bonds being at 5% versus 4%? And will this mean tax rises and budget cuts might be likely in the autumn budget?
So, I mean, once again, the Office of Budget Responsibility have written about this. I think something to bear in mind with government gilts is conventional gilts in the UK have an average maturity of about 15 years. So even if there is an increase in interest rates, it takes quite some time for that to flow through into the average price of government gilts because, as they mature, new ones are issued. But there's quite long lags there. So in the Economic and Fiscal Outlook that the OBR published on the 3rd of March, they estimated that over a 5-year period, a 1% increase in interest rates would add around 15 billion to additional borrowing, and over the longer term, around 30 billion. But obviously the short-term effects are more limited. In terms of the short-term impacts on public sector borrowing costs from government gilts, I think you would see it more immediately in terms of the effects of a higher retail price index on that quarter of gilts that are linked to the RPI. That has a more immediate flow through and is probably more volatile than the effects of higher or lower interest rates on the average cost of servicing that debt. But nonetheless, over the longer term, if an increase in interest rates is sustained, it will add to public sector borrowing.
Thank you. And yeah, just to re-emphasize that, so as part of the public finances, we do publish estimates of debt servicing costs. So over the coming months, if there is that effect, we will pick that up in our kind of commentary around that. But yeah, there's quite a few components that feed into what is the effective debt servicing cost there. But yeah, one to potentially look out for over the course of this year, particularly what's happened in the last couple of weeks there. And then the final one we've got in the Q&A is, could we discuss the main impacts of the kind of war in the Middle East on Northern Ireland that may differ from those on mainland UK? So I don't know if it's one we'll necessarily kind of go into specifics. I think a lot of the mechanisms that we spoke about here in terms of particularly the immediate inflation impacts, but potential second round impacts would translate to all parts of the UK. And as kind of Grant spoke about, it's just that exposure. So one bit you might look at is the kind of industry composition of the Northern Ireland versus the rest of the UK to see if it is more energy intensive, to see if there are some more effects feeding in via that way. But we'd suspect that is how it would be looked upon. But we can obviously comment on that in the future if there are kind of more regional effects taking place. So I think that is all the Q&A that we've got through, and I can see that Chris has posted the material he spoke about on international migration. So look, a big thank you to everyone for that. Hopefully that was useful to kind of go through some of that, and obviously we'll come back to you in future economic forums as some of these impacts might unfold a little bit further. So I'm just going to do some closing remarks in the next 5 minutes or so. Thank you very much. If we could just go to the next slide, please. Just to let everyone here know about the upcoming ESCO conference. So this is taking place in May, from May 19th to 21st, taking place at King's College, London. So this is a conference that takes place every year where we collaborate with the ESCO. and it's one we're keen to kind of invite everyone here to come along to. The conference is free to attend. That is an in-person one. You can see some of the keynote speakers that we've got lined up this year, which is a very exciting one. Some excellent speakers, and I also have seen some of the other materials that are being covered there, including those being produced by the ONS. So if you are interested, registration is open between now and May the 5th, and you can find more information also on the draft programme at the hyperlink there. If you go to the next slide, please. Now, a big focus of the updates that we've been providing over the last year or so is just how critical our social surveys, but also our business surveys are. And one bit that we're always looking to do is just really understand that user engagement perspective, particularly those who receive these surveys. We realise that is an experience that we need to understand more in our efforts to kind of boost participation. So today, I just want to kind of give you a bit of a preview of some of the work that we're doing on business surveys, where these are one of our most critical inputs that kind of go into the stats production of GDP, inflation, and bits of the labour market, for example. And so what we're doing is a consultation exercise. So I don't know how many on the line might be a potential business survey respondent, but we're also really keen to kind of understand your experiences so that we can improve how we go about the future design of these ones. So if you are interested, you've got some views on that. We'd love to hear from you. I've got the hyperlink here. We'll circulate the slides afterwards so you can see these as well. And yeah, we can obviously respond to your needs and hopefully tailor future business surveys more accordingly to that. And this is open till 1st of May, so you've got about 5 weeks or so. So yeah, please do take part if that is a relevant one. Next slide, please. Now, here's just a run through of some of the outputs that might be of interest over the next month or so. I expect we'll cover some of these in future economic forums as well. So you've got some of the kind of core outputs that we produce, but there's also ones around green jobs, which is of increasing interest, which kind of captures how much employment there is in the so-called green economy. And this one's on housing affordability as well, which is always gets a lot of focus too. So there's more information available, but there is some here that this might be of interest. Next one, please. And just another consultation that's open. This is part of our work on international frameworks. You might be aware that the international community is going through the process of implementing new changes. These not only underpin kind of national accounts and balance of payments to public sector finances, but there's also ones on industry, and this one is on occupation. So particularly interested in the labour market and kind of the roles that we individually do. So this is a process that takes place every 10, 15 years or so. Now, if you're interested in providing some input into that, there is a live consultation that's open to mid-May or so. So yes, if you do have any views that you'd like to share, please do take part in this exercise. As I say, we always welcome your feedback, and it's something that we can kind of respond to as part of our response to this update to the standard occupational classification. And then the next one, please. Which is just around feedback. Because I'm wondering if we have a poll for this one. I know there was a moment, so I think it's just been posted. Just bear with me. So we'd like to do just a live poll, because what's hopefully clear, not only today, but over the last few years, we've been doing these economic forums that we look to tailor these to your feedback. And so we can kind of get these as best as we can to respond to your needs. So there is a live poll that can take place if you go via the Slido link. If you can just give us a minute or so, we'll go through that very quickly, and as I said, we'll take stock of the feedback that you provide, and hopefully you can kind of implement some of these changes going forward. So I'll just give you a moment to do so, but as I say, shouldn't take too long to do. So what we might be able to do is just post or repost. Actually, I can see it's there. So if you just click on that link, you can either do that now, or feel free to take some time after this call if easier. And as I said, we'll take stock of that feedback and kind of respond for in the next couple of months or so. So look, I think that brings us to the end of our forum. Just a big thanks to all of our speakers today, but also those who came along today. Really appreciate it. Hopefully you enjoyed it, and we look forward to welcoming you back in May. So big thanks to everyone. Take care. Enjoy the rest of your week.